We've had an amazing recovery so far. On Tuesday, many growth stocks are up 4, 5, 6, 7, 8%. And a lot of investors are feeling FOMO. They're feeling the fear of missing out that because so many stocks are up, and maybe you're still holding a cash position, you believe there's no more opportunities. But this couldn't be further from the truth. This is a highly concentrated market, and there's still a lot of companies going down, and they're trading near their 52-week lows. I'm going to talk about two of them in today's videos. Those are more growth-oriented stocks. I talked about them before. I'm going to talk about them again. So I really hope you enjoy it as always. Now, the first one is Grab. Grab is down almost 30% year to date. There's no signs of life on the stock, mainly due to oil prices that are affecting other regions much more than the United States. And a few more reasons which I'm going to talk about. Now, Grab is the Uber or Lyft, or mainly Uber, I should say, of Southeast Asia. They operate in Thailand, Myanmar, Malaysia, Vietnam, Philippines, Indonesia, Singapore, and so many other places. And this region of the world is rapidly growing, but they also have a much lower penetration in mobility and delivery kind of orders versus the United States or versus Europe. So the company is riding a massive, massive tailwind. But most importantly, they don't have the autonomous vehicle risk that's presented for Uber and Lyft in the United States. Over there in Southeast Asia, the roads aren't the best. A lot of people live there. They told me it's not really as big of a risk. I mean, a lot of people, they drive on motorcycle for delivery drivers and other kind of things. So it's not as big of a risk. And that's really, really amazing. Now, the company makes money in three different ways. The first one is through deliveries. This is the biggest part of the business, growing 18% year on year. The second one is mainly mobility. This one is growing 15% year on year. And mobility, again, has like a 4 or 6 or 9% penetration. It should be like 30, 40%. It's barely 6 to 4 or even 9%. So the company has a long term, you could say, a tailwind and a long-term mega trend that it will be riding in those regions, which should reaccelerate the growth in a major way. Now, another part of the business is mainly in lending and banking, insurance, digital banking, but mainly you could say lending and online banking in general. This has been a rapidly growing part of the business with 7.4 million banking customers. And this is why Grab is trying to become more of a super app. I would argue it's already a super app because a lot of people do all their finances, all their orders, everything on the Grab app. And it's really embedded in a lot of people's lives in Southeast Asia. Now, the company has done a lot of nice acquisitions. This is one of them that I would like to show you, which is mainly like a drone delivery kind of a service. And then they have another physical robot that just goes in the hotel room and delivers it to your door. I believe not all of it is real. I believe a lot of it is like a prototype, but they acquired this company in Move, and they're going to work on those things. And you could only imagine the long-term, you could say, margins and long-term tailwinds and long-term savings that they can get from implementing those kind of services. Maybe not right now, but maybe more over the long term. They also acquired a company called Food Panda, which is a really big competitor for them in Taiwan, and the market believed that they overpaid. But an analyst actually said they did not overpay. They paid cash about like 0.33 times gross merchandise value, or GMV, which was not too expensive. But this is 30% lower than the $950 million price tag that Uber has offered them back in 2024. It's the same business. The company has likely grown in this period, but they offered 30% less and they got the deal. Uber couldn't get approval from the regulators, but Grab did get the approval, I believe, and they will likely integrate it, and it's going to be an amazing acquisition. Now, another acquisition which I couldn't understand at all is the acquisition of Stash. And Stash is more of a investment app in the United States. It has nothing to do with Southeast Asia. It's more of a robo kind of investment app. But maybe they want to integrate it in Southeast Asia. But there's a lot of competition on that in the United States from Robinhood and SoFi, and everyone is doing it. So Stash doesn't have the competitive edge that it once had. And this one, I didn't really understand it, to be honest. The company is also buying back some stock. They're going to execute $400 million buyback over the next 4 months. So they clearly believe the stock is undervalued. Now, there's some risks, and I'm going to talk about the bearish thesis here for Grab. And this is mainly the massive competition in those markets. This is not as clear as Uber was 10 years ago, where it had little to no competition, maybe Lyft, but Uber was just killing it and taking market share and expanding margins. It's not going to be as easy for Grab to replicate it as it was for Uber. And if you look at the partner incentives for Grab, which is mainly incentives they pay to, you could say, encourage transactions, maybe some like 20% off or 50% off or free deliveries or whatever it is, things to encourage transaction and encourage people in general, it grew by 40%, while the revenues only grew 19%. So this is growing twice the pace of revenues, and the rate of the growth has been reaccelerating in recent quarters. So that would tell me that Grab is trying to aggressively grab market share. Maybe they're doing it now so they can just take market share and then monetize them in the future, like Amazon did. That's possible. But to me, it looks like there's a lot of competition there, and Grab is having to spend more and more to acquire and to retain and attract those customers. And this would not be a good sign for the company. Now, in terms of the valuation, the stock used to trade at like 130 times earnings. Now trading at 37 times earnings. It's much better for a company that just turned profitable and expected to grow earnings per share like 50, 60, 70% for many years to come. But I think the best way to value Grab is to use the company's own guidance. They're guiding 20% CAGR in revenues into 2028, but they're also guiding $1.5 billion in adjusted EBITDA and about an 80% free cash flow conversion rate, meaning 80% of the EBITDA will likely make its way into the free cash flow. So 80% of $1.5 billion is about $1.2 billion. If you look at the enterprise value of Grab right now, it's about $9.7 billion. And you're getting $1.5 billion in free cash flow by 2028, which is 2 years from now. So you're basically paying 8 times cash flow for like 2028. This is extremely cheap for a company like Grab. It should be trading around 15 to 20 times enterprise value to free cash flow. If that was the case, that this is a double or triple potentially by 2028 or 2029. So I could make it really simple and you could really see how undervalued the stock is. I think the biggest risk is, of course, the competition, but they're trying to acquire this company in Taiwan. They try to acquire more and more companies, and the competitive landscape will likely get better over time if the company stays focused on taking market share and on becoming vertically integrated in banking and a few other things. And by the way, I'm using Fiscal.AI to come up with those charts. If you'd like to try it out, they give you 2 weeks of free access if you use my link in the description. Now, the second one is Duolingo. I haven't talked about this one in a while. The stock keeps on going down. It's crazy. It's down like 48% year to date. And mainly the most recent one was an announcement from Google where you can hook up any headphones to the Google Translate app, and those headphones will automatically translate to you any languages in real time. And a lot of people in the comments are saying that this is going to be the death of Duolingo and no one will need Duolingo anymore. Well, someone on X that owns Duolingo, he said something really funny. And he said it's like whenever we had calculators, we invented calculators, we didn't say we're not going to learn math anymore. We kept learning math, but we used the calculator to help us. So in this case, if someone wants to learn a new language, are they gonna not learn a language just because they can hear it on the headphones or whatever? But maybe they like to learn something. They're just learners. In this case, they might choose Duolingo, especially if they're younger in age, especially if they like to play a game and learn something that's a little bit fun. Maybe their job requires them to learn a specific language. Maybe they're traveling somewhere. They don't want to depend on earphones all day or ChatGPT. They want to do it on Duolingo, challenge their friends, and do other things. But most importantly, Duolingo is not just a language app. They're transitioning into chess, math, and music. So unless Google's headphones or whatever, or ChatGPT could prevent you from playing chess with your friends and learning chess or learning math or music. You don't need none of those things anymore. I don't really know about that. So again, the company is diversifying away from just learning a new language, and they're working on it. You could say tutor app for the K-12 math. And I would not be surprised if over the long term, Duolingo starts scoring partnerships with a lot of schools to develop some kind of a fun way to learn math or something like that. I would not be surprised at all. Now, the last report was really good for the company. They grew 35% in revenues, booking grew 24%, net income margin expanded. Everything really has gotten much better, but guidance was terrible. The company guided 10 to 12% in booking growth and 15 to 18% in revenue growth. The company used to grow 25, 30% in bookings, and now it's guiding only 10%. That was a massive disappointment. Now, in terms of what the CEO said, and this is really important, it's to pay attention to the wording of what he said. And he said, we expect booking growth of 11% in 2026 compared to the nearly 20% we believe we could achieve if we operated like we have in the past years. We could achieve. So if the CEO was just focused on growing at any price, they could have done that, just like they did before. ChatGPT was here, all those programs were here. They still grew over 20%, and they could do it again, but they're choosing not to because the company is taking a different approach, and they're taking an approach of maximizing daily active people. Daily active people right now is about, I think, 48 or 50 million. They're trying to take it to 100 million by 2028. And I said, if we succeed in doubling our daily active users, the payoff would be huge. And this is a big one because Duolingo doesn't only have a paid subscription. So they don't have to get 100 million paid people to generate money from them. They can have 100 million daily active people. Some of them will be on a paid subscription, and some of them will be on a free subscription. But the free subscription is not really free because Duolingo is advertising to them, and the advertising business of Duolingo generates 20 million a quarter. A lot of people don't know that. So this is something they can expand and they can work on it, especially with AI. And this is the company's focus again. They want to get to 100 million people, and once they get them on the app, using the app every single day, then they can monetize the 100 million daily active people. This is a much better approach than maximizing short-term profits and growing at any price. So I think the CEO is doing the right thing. Now, in terms of the valuation, again, it should trade at like 175 times forward earnings. Now trading at about 33 times earnings. So this is my valuation model on Duolingo. I put in 290, then 18%, 18% in earnings per share growth. This is what the company is expected to grow in revenues. So I kept earnings per share similar. Then 2028 to 2030, I took the growth that would reaccelerate to about 25%. And a lot of you might ask me, why did you decide to do that? You normally price in a slowdown in earnings per share growth, but in this case, I'm actually putting in an increase. And the reason I'm doing that is despite the company's massive investments into more shorter term stuff to grow for the long term, they're kind of suppressing margins in the near term, which is why earnings per share will likely grow around 17 to 18%. But after they get 100 million people and they decide to monetize them, I believe the company will experience a margin expansion again. And in this case, I would expect earnings per share to reaccelerate potentially to 25%. The current PE is 33 PE. I put it at 25 PE. I believe it's fair for the growth and it's fair for the 30% plus net income margins. In total, I got about $200 per share. Current price is $91. This is over 117% on the upside, or almost a 17% annual return for buying Duolingo at today's price. So for me, I believe Duolingo stock is undervalued. I think Grab is undervalued. I would personally prefer Grab over Duolingo because I love how kind of Uber did it and Lyft did it. And Grab is not trying to do something that's never done before. They have the playbook. And the CEO of Uber, I believe he's on the board of Grab. So there's a lot of support over there. And Uber owns a stake in Grab. So I see a much clearer setup personally with Grab than with Duolingo. And that's my opinion on those stocks. Hope you enjoyed it. Hope you got some ideas. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.